And hope you're doing well today. It is Thursday, the 15th of July, and just going to run through what's happening, what we've been looking at, what happened yesterday, what we should be doing to prepare for the day today. So let's go ahead and get into it. Let's start over here. We'll start over here first. What happened yesterday? Well, we actually had 3 trades yesterday, which is unusual, actually. We don't always have trades on every instrument, but we did. We had 3 trades yesterday. We had a trading opportunity here on the S&P. We had a trading opportunity on crude, and we had a trading opportunity on gold. So let's see what happened there. Yesterday, as we came into the market for the S&P, we were looking at a long trend. The 4-hour was long, the 30-minute was showing us long. So what do? We wait for a pullback. We want to see the market make lower highs and lower lows, which is exactly what it did here. Made lower highs and lower lows. And then we want to see the market snap back into the direction of its current market trend, which is long. And it did that. It broke back up to the long side. We broke above the previously closed lower high, and the market moved on. We did ratchet off risk, ended up just a little better than break even over here. Let's see what that worked out at. We on this one, let's see, yeah, basically break even, 1.5 points on it. Now this is an interesting piece though, because this initial risk would have been greater than we typically would want to risk. So we've talked about before, if you've got a $10,000 account and you're trading $10,000 account, keep your risk around $500 maximum on any given trade. That'll leave you a couple of things. But the big thing there is it puts you in a position where if you do have a full loss, you're not putting your account at exaggerated levels of risk, right? Now, let's go ahead and finish this up, then we'll talk. Well, let's just go ahead and talk about it now since we're on it. So if you're trading a full lot, just one standard lot on the S&P, and you go to put your trade on and you see that your entry point to your maximum risk point, so your entry point to your stop loss, is going to produce a result that's greater than whatever that maximum risk is that you're comfortable with, whether that's $200 or $300 or $500, whatever it might be. If it's greater than that, then you've got some decisions to make. So in this case, our entry point to our max risk point here would have been about $587, which is beyond that threshold, right? So what do you do with that? Well, you do a couple of things. You can either go, oh, I'm just going to ignore my threshold, which is a very bad idea. Or you can adjust your lot sizing. So if you're trading a standard, one standard lot, what you can do is chunk that down into micros. So maybe instead of just trading one standard, you're going to trade 7 micros, or 8 micros, right? Which now puts you in a position where you've got a smaller lot size on, and you're able to keep your maximum risk at a point that's reasonable for your account size, right? That's really important. Managing risk is, honestly, it's job number 1. Consistency is well, managing risk is job number 1. Consistency in your entries and your exits is job number 2. But managing risk. So you either don't trade, which is fine too. If it's exceeding your risk parameters, just don't take the trade. Or you can adjust. If you're trading an instrument that allows you to adjust that down, trade fewer of whatever it is that you're trading. So if you're trading a standard mini lot, chunk it down to micros. Now you've got a way to accurately manage the trade sizing so that you don't exceed your risk tolerance thresholds. All right. What happened on? So that one ultimately a little better than break even, but break even, but yeah, just leave it at that. All right, crude. What happened in crude? Crude, same thing. Came into the session. We had, even though the market was fairly flat, we did have a long bias. The 4-hour was long. The 30-minute was long here. So we had a 4-hour bias there. And what happened? Market pushed back. Lower highs, lower lows, lower highs, lower lows, lower high, lower low, and then it started to break back out in the direction of that current market trend. It touched just above that previously closed candle, which is what put us into the trade here, and then it just reversed on us. Now, trailing our stop up as this candle closed, we were able to pull our stop up a little bit here, which would have reduced risk, taking risk off the table. So initial risk on this was about 380. We ended up losing 260. So we took a loss that was less than the amount that we had planned to take, which is always good. It is what it is. As I've said time and time and time again, we're going to have losses. That's just part of trading. As a matter of fact, using this trading method, you're going to actually lose more than you win as far as just a one-to-one ratio. You're going to lose more than you win, but what gives us the edge on this is the actual amount of the winning trades exceeds the average loss, and that's what gives you your long-term expectancy, right? It's not how many trades specifically did I win, it's how much did I win versus how much did I lose. It's another big deal. It comes back to the risk management. When we're managing our risk appropriately and we've got profit targets and we're taking profit at levels that are exceeding what our average loss is, that gives you positive expectancy over the long term. You don't have to win 60, 70, 80% of your trades. You can win 40% of your trades, and you can still be very profitable doing it. So anyway, I don't want to go off on a tangent with that, just something to keep in mind. Let's finish up over here what happened yesterday. Gold, same thing. I don't know why that's not showing up. But anyway, gold, we had long bias on the 30-minute, long bias on the 4-hour. We're looking for long trades. But we wanted to see the market pull back. So again, we've said before, we want to get things at a bit of a discount. So the market pulls back as the new session gets underway, and we've made lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, waiting for the market to push back in the direction of its current trend, which is long. And we can see that we're getting our green entry arrow saying, hey man, watch this candle. It just made a lower high and a lower low. Enter if it breaks out. And it did. It broke out here. Pushed above that previously closed candle, and then it was flat for a little bit, but then ended up pushing on and getting us into a little bit of profit before it took us out. Took us out almost to the tick on this candle, and then moved on further. That's always a little bit frustrating, but it is what it is. So ultimately had a small win here as well. I don't know what that was, just right about a point. So but anyway, small win there and moved on without us, but it is what it is. So what are we looking at for the day today? Well, we're looking at the exact same process. Nothing changes. Don't try to reinvent the wheel, second guess, do anything else. We're just going to trade what the market tells us to trade. Now, we do have some news coming up today. We've got Mr. Powell that's going to be testifying here in a bit at 9:30 Eastern, 8:30 Central. So that'll be happening, right as the new market session, the regular trading hours get underway. We've got some lower impact news as well, but this is the one to watch. This could be, depending on what sound bites come out of that, could be pretty, could be market moving, market impactful. The big thing is, the big takeaway from that is don't overthink it, guys. Don't overthink it. A lot of people will watch the news, they'll hear the sound bites, they'll hear what he says, and they'll like, oh, well, the market should be doing this. The market does not give a damn about what you think it should be doing. Just work your system. Let the market do its thing. If it starts falling off a cliff, it falls off a cliff. And we make trading decisions after all that stuff gets out of the way and all the emotions out of the market. And then we can make some trading decisions based on quantifiable information that we're seeing on our charts, right? So what are we seeing on our charts? Well, as we're coming into the ES this morning, the S&P 500 index, we've got a mixed market. We've got the 30-minute is showing short, but the 4-hour is still showing long. So that tells us don't do anything. Boom, sit on your hands. Crude, same thing. 30 minutes short, 4 hours long, don't do anything. Sit on your hands. Let me see I don't know why this one isn't showing me my stuff. What are we doing here? Show me my stuff. Where is it? Yeah. There we go. It's not showing the time frames there. There we go. So gold, we've got 4-hour biases long, 30-minute biases long, and we're looking for long trading opportunities. What'll that look like? It'll look like this. We want to see the market making lower highs and lower lows, lower highs and lower lows, and then we'll play a breakout of that previously closed lower high. But we want to wait until we get underway and have our regular trading hours trading with us. So that is it, guys. I mean, it's pretty darn simple. We do the same thing every day, and that gives us a positive expectancy over the long term. It helps us manage risk. It helps us manage our emotions, and most effectively, it gives us some freedom in our day because we only have to check this once at the top of the hour, once at the bottom of the hour. Super easy, not time-consuming trading process. All right, so that's it for now. If you have any questions, let me know. Otherwise, we'll talk to you later.